And welcome, ladies and gentlemen, to Voice of Appraisal's coverage of the RAC Conference in Plano, Texas. I'm here with Ernie Durbin of Clarosity, also a Cincinnati boy, just like I am. Two Cincy boys here in Plano, Texas, battling it out, taking care of issues of the day. And how you doing today, my friend? You doing okay?
Very well.
You doing all right?
Yeah.
So the RAC Conference, tell us a little bit about it. How long have you been a member?
I have been a member, I'd say going on 12 years or something like that.
12 years in RAC?
Been on the board for the last 9 or 10 years.
And you personally have done a lot of relocation appraisal work?
That really has been my specialty through the years.
Okay, yeah. Very good. I like doing relo work as well. It really does require the appraiser to look deeper at a bigger picture behind the analysis of what you're doing. You know, you have to. For those of you that don't know, relocation appraisal requires a substantial amount of forecasting in market conditions, forecasting on buyers' tastes and standards, things like that. So it is a very specialized form of appraisal work.
It's a completely different definition of value, right?
Yes, anticipated sales price. That's exactly right. So you and I, we've had our differences in the past, but we can come together, of course, here as friends at the RAC Conference, because we always back the RAC.
We've always been friends.
We've always been friends, and your dad's he was a wonderful appraiser, a wonderful person. My father speaks quite highly of him. Cincinnati is the biggest small town in America, folks. I'll tell you that right now.
Yeah, my mother actually hired my father.
Your mom hired your dad?
They were both SRAs.
Is that right?
Yeah.
Is that right?
My mom's still alive. She's 92. Has to be the oldest living SRA, maybe.
The oldest living SRA. Yeah. Back in the glory days of the Appraisal Institute. Back when the numbers were massive.
Well, wait.
And the pool was amazing. But these days...
This is before the merger with the society. I got into business in '82, and I'm happy to see you young people joining in, you know.
And we're aggressive, and we're really passionate about things, you know. And we are young, don't you think so?
I'm still young.
Yeah, you're still young. You're still young. All right, let's talk a little bit. Let's talk big picture here, because you and I don't usually get the opportunity to sit face to face like this.
No.
So let's talk a lot about AMCs.
All right.
And let's talk about the so-called appraiser shortage that's in America today. Is there an appraisal shortage in America today? Appraisers out there today, is there a shortage? Ernie Durbin, Clarosity.
There is not a shortage of licensed or certified appraisers.
Okay.
Now, there was some hesitation there, right? Right?
Come on, let me hear it, baby.
Right,
this is it. Let me hear it now.
I am just going to contend that there's a large amount of licensed and certified appraisers out there that have cut their teeth on the 1004. That's what they're used to doing. And they really are, I would describe them more as form technicians than people that cognitively think about value. So if we were to talk about appraisers that invest in their profession, that go to conferences like Appraiser Fest. There you go.
The Appraiser Fest, which you will be at.
I cannot.
You're going to be at NAR, aren't you?
NAR. I'm on the Real Property Evaluation Committee.
But someone maybe from your company will come to Appraiser Fest,
Absolutely.
You think? Okay, so someone from Clarosity will be at Appraiser Fest. Ernie will be at NAR in Boston, right?
And I actually tried to, Tom Allen and I were trying to, he's on the same committee.
Yeah.
And he's a RAC member, and we were trying to figure out a way to do both. The flights just don't work.
It didn't work out. That's okay. I won't hold that against you.
But anyway, back to appraisers. You know, there are appraisers that invest in their career, that spend time keeping their skills sharp, that stay up to date on technology, that understand USPAP, and those are appraisers.
Yes, they're here.
Yeah,
they're here at RAC.
But I think there might be a shortage of those appraisers.
So you're saying there's more so-called form technicians, the quote-unquote form fillers out there today.
Right.
But are there enough quote-unquote form fillers to be able to support the demand of lending institutions throughout the country?
Absolutely.
So there's plenty.
Well, so and again, back to my initial statement that was kind of couched in a little humor.
Yeah.
I don't know if it came off that way.
Go ahead.
But there are certainly enough, today there are certainly enough licensed and certified appraisers to meet the demands of the market.
I totally agree with you. I totally agree. Now let's talk about another question here. Of these licensed and certified appraisers, some being better than others, we can agree on that.
Agreed.
There's a lot of people out there that do not want to work for a great majority of the appraisal management companies. There are good AMCs out there. There's some very good AMCs. They take care of, they look at their subcontractors as partners. Their compensation is very good, things like that. But there's a substantial amount of appraisers that will say, and it's all based on economics, and I'm not going to bring up customary and reasonable fees. We're not going to even mention a fee. But it's all based on economics here.
I agree.
And the bottom line is there's a big problem with the appraisal management companies that are out there today.
The economics are not good, right? So, and a lot of that, I think you and I had a little private conversation last night while imbibing in adult beverages.
That's right, with no fee discussion, by the way. But go ahead, go ahead. I have to get that out there. Yeah, but go ahead.
But we had a private discussion last night about the, what's wrong with this economic model, and I think we have to realize that AMCs are, I mean, they are a classic middleman. They're the same thing the doctors have gone through with HMOs,
right,
and other industries. The problem that I have is I wish lenders regarded AMCs as what they truly are, and that is an outsourcing of the responsibilities that used to be theirs internally, right?
Right.
So whenever you outsource this, I wrote an article on this, and you can look it up out there. It's called "The Elephant in the Room." It was an appraisal.
Elephant in the Room. I remember that because I pulled an elephant out during the appraisal summit several years ago.
Yeah, I remember that.
I was interviewing.
I was not there.
I was interviewing the National Appraisal Congress, which has been disbanded now, I think.
Right.
But go ahead. So you did.
Congress
you wrote an article.
out of session.
Congress is gone. Okay. Congress is gone. But you wrote an article about the elephant in the room, and it was the economics behind it.
It's all about customary reasonable fees, and we're not going to rebuild this industry if it's not a lucrative industry to be in.
That's right.
That's what it boils down to.
Right.
And when you have AMCs that are competing for business with lenders, and they're not using a cost plus model, which is what I endorse.
Yeah.
And they're basically they're going into a lender and they're saying, well, look, what are you paying for an appraisal fee? And whatever it is, X. Well, that's all we'll charge you. Well, guess what? That means that whoever they're using as an appraiser now, that they'll want to onboard to continue to serve that lender, the management company's got to take their margin out of that, and they take it out of the appraiser's pocket.
That's what they do. That's right. Yeah.
And so that model is, I don't think it's sustainable.
Well, not only is it sustainable, I think it's damaged a great deal of appraisers out there today. From 2009, and you have to admit this, from 2009 to probably around 2015, and that's about the time you wrote your article.
Yeah.
Okay.
16,
so you're looking at 2009 to 2015. You've had a business model that's been practiced by a lot of different businesses that basically parasited off an entire profession and brought its numbers down farther than what it should have been, because it was all just a matter of economics. Hiring somebody, training somebody, bringing somebody on was not economically feasible at that time because of this business model.
Yeah, I'm not even sure it's still economically feasible.
Well, if there's a good AMCs out there, and there's people that work directly with lenders now, because some of the lenders are realizing, hey, look, this business model of the appraisal management company is not in our best interest. We're not getting the best, most qualified appraiser in certain areas because we are farming it out to someone who's either getting a lower fee or they're looking at the total commoditization of the industry.
And the AMC space is highly commoditized
and highly aggressive and very, very competitive.
But I would say there are lenders out there that are rethinking, completely using AMCs, and what they're doing is
rethinking not using them.
No. I'm saying that they're yes, but I'm saying it differently.
Okay.
What I'm saying is they're thinking, hey, let's do our own panel management in some areas, and then when it's outside of our footprint, we'll use an AMC, right? Because again, it's an outsourcing issue. Right. But if they begin to look at AMCs the way they should be looked at, and that is as an outsourced service, then they should demand their appraisers be paid customary and reasonable fees, what they would pay for their normal panel engagement with the lender.
Right.
And then if they're going to have someone else manage a portion of the process, then they pay above and beyond. That's a cost plus model.
But that's a cost plus model, and you saw that as far as banks dictating the fee. You saw that with, what was it, BB&T Bank just recently said, this is the fee dictation that we're going to have.
They adopt the VA schedule.
The VA fee schedule and stuff like that. So they're starting to realize for the first time, and I think a long time, that some of these business models are not the best. But we've had so much propaganda out there from the AMC side, side, because let's face it, there's a lot more money on the AMC side than there is on the fee appraiser side. There's too much propaganda out there saying, hey, look, this is what we need to look at, while these same people are parasiting off of the profession.
I'm trying to understand can you give me an example of propaganda?
The propaganda is if somebody comes out who works for a massive AMC and says, look, you have to do this, you have to do this, and we have to do this, but at the same time, their business model is exactly opposite of what they preach to be doing, then that, I think, is a smokescreen and propaganda. All right? We see this time and time again. If you take a look at perhaps Riva and their individuals that belong to Riva, they have a certain goal that they have in mind to make money. But at the same time, has anybody from Riva, has anybody from the CRN, has anybody gone to the banks themselves and said, guys, it's in your best interest not to adopt our business model, but it's in your best interest to adopt this other business model, the one you put out, the cost plus model.
Yeah, I cannot speak for Riva, because we're not Riva members.
Right.
You know that I'm on the executive committee of the CRN.
Right.
And I can't speak for the CRN either. That's not my role today.
I understand that.
But I can tell you that I know members of the CRN, ourselves included, that have gone to lenders and have spoke about the cost plus model and appropriate appraisal management. So.
Appropriate appraisal management. Now, that's a great way to say it. I like how you said that. So, are you becoming more active in that role? Because the issue that we see now is that we need to have all of those resources and all that money that has been used to present themselves as one thing. We need to go now to the lenders and say, look, it's going to be in your best interest to adopt this other business model that may get you a better result and a higher quality appraisal than what you're usually dealing with.
Yeah, and it's interesting. You know, I've heard all kinds of. I mean, I read the bulletin boards and things like that.
Sure. And you listen to the podcast.
I listen to your podcast, along with Dustin's and many others.
Yeah.
But the moral of the story is. I hear this narrative that well, AMCs just want the cheapest appraiser they can find, and if that's the cheapest appraiser, that means that they're going to be the lowest quality appraiser, and so ultimately AMCs are headed for the bottom of the barrel selection of appraisers. Mm-hmm. I can tell you from my experience working inside several AMCs, we absolutely want the highest quality appraiser we can find, and in the model, if you adopt the cost plus model, that cost is passed on to the consumer ultimately anyway.
That's true.
Now, the argument that I made in the Elephant in the Room article was, hey, really, let's get the CFPB involved in this, and let's here's a word that's a buzzword around, bifurcate, but I'll just say divide. Mm-hmm. Let's divide that fee on the HUD-1 and say, you can't charge the consumer for the appraisal management piece.
That's very true.
You should just charge them for the valuation piece for the appraisal.
And that is changing a little bit, though, now.
But then, of course, the lenders they'd have to be writing checks for appraisal management. Right now, most of them are skating by scot-free. And what used to be a cost center that they had is now being paid for by the consumer in higher appraisal fees.
Yeah, that's true.
Because lenders or AMCs are trying to match customary reasonable fees. So now we have higher fees that go to the consumer. And really, a lot of that fee used to be the bank had, brick and mortar. They had review appraisers. They had all this staff that are now inside the AMCs. But who's paying for it, Phil?
Well, the consumer is.
Right.
Are you working through your connections?
My argument was, hey, and I went and met with the CFPB. And
met with the CFPB?
I did personally.
The Consumer Financial Protection Bureau.
I did.
Yeah.
I went.
It was ran by a Columbus person, by the way.
Yes.
Yeah, that's right.
Was.
Yeah. Go ahead.
He's out.
All good things come from Ohio. But go ahead. So you met with the CFPB, and what did they say?
I did personally. Took the article in there, made the argument. Well, nothing's changed.
Nothing's changed.
Yeah. So, well, I mean, there's the wheels don't move too quickly in Washington, but we still try to make those arguments.
Okay.
I try to make those arguments. To me, look, Clarosity is a very small AMC. Very small AMC.
Well, you're a software company too, as well as an appraisal management company.
Yeah. So we have Clarosity Valuation Services, which is our AMC, and then Clarosity Incorporated is the software arm.
It's software arm of it. Okay, so let's take a look here really quick at bifurcation. Now I have.
I was going to make a point about the size of AMCs.
Please,
right?
yeah, please.
So some of this is the fact that my tribe is appraisers. I've been doing this, you know, I'm an SRA. My parents were SRAs. I've been in the appraisal business. They've been in the appraisal business since the 70s, myself since early 80s. So this is my tribe. I love appraisers. But selfishly, part of the argument for the, and I say selfishly in terms of Clarosity as Clarosity Valuation Services, as an AMC, is that levels the playing field for us if we get to compete based on our service to the client and the value add that we have in the management cycle versus just trying to get the lowest fee for the lender.
So let me ask you a question. You talk about,
we don't have the scale of some of these other giants.
So it's a great point. So your value add has got to be more than just a situation where you're helping a client out with compliance, with AIR, with appraisal independence requirements, which basically the AMC was to put in place to be put as the barrier between the loan officer and the appraiser to make sure that there was an independence requirement.
That's the way they sold it.
That's the way they sold it.
Right. You can meet AIR requirements, and I know many banks that do.
Of course, right.
That are still internally managing, and they do fine.
They do just fine. So you're saying in your world you have to have that additional value add to compete with your competitors, right?
Right. Yeah. Right. And so we try our best not to compete on price, but on service and quality. And, And I mean, we're a little different. We don't do hardly just. I can count on my hands the amount of true origination work we do. Yeah. Our company is mostly in the default and servicing and portfolio management space.
But see, and I've always said, and even on the show I've said many times, the bifurcated products, the desktop products are excellent for low LTV loans, for portfolio acquisition, for pre-foreclosure drive-by, where the bank needs to have that answer back and have an idea as to where they stand. I totally understand that. But what is your position on bifurcated products? And this is a big question. Desktop bifurcated products, we have someone going out to the property, inside of the property, not just a drive-by, but inside of the property. Not connected or affiliated with the appraiser in those purchase transactions, in those high LTV transactions, 97%, 95%. What's your opinion on that? Do you see some problems that could arise in risk assessment if we go down this direction?
Well, of course. I mean, the lowest risk you are going to have is having the appraiser physically inspect the property.
Correct. I agree with you. Right.
You know, there's no question there. So I think whenever we look at that, we see. You know, we can see that like you've already noted, there's a stratification of risk, both in terms of LTV, creditworthiness, other things that go into that collateral risk decision-making process. There's a lot of problems with the bifurcation. Now, our company does bifurcated, our software company is built around that.
Okay, all right.
So, but that doesn't mean that I can't see the flaws and the pitfalls from a bifurcated process. For instance, if we were to move that direction for all appraisals,
what about that?
You're going to have appraisers lose touch with their marketplace. You know, because they can't get out. They need to be out there in the field. I know Butler County, Ohio, backwards and forwards.
Yes.
And I'm a good person to do bifurcated appraisals there, because guess what? I've been in all those.
You've been in the same subdivisions I've been in 100 times.
But if you keep me in the office for 5 years,
you lose touch.
I'm gonna lose some. So I think we've got to keep appraisers in the field and involved to a certain point.
But don't you think there's a balance here? There's a balance between scope of work and the needs of the client. And what I get really frustrated with, Ernie, is that when some new idea comes out, some new concept, then all of a sudden the pendulum swings all the way over, and this is the way we need to do it from this point on. Yeah. And all of a sudden it's called modernization. Everybody's got to jump on it because you're a tech guy, you know things about things. But you know, it drives me nuts. There has to be a balance all the way down the line, you know.
Well, what is supposedly new, I started doing in 2007 in Cincinnati, this bifurcated process.
Yeah, you had bifurcated products. And you know, and a lot of the bifurcated process that you're talking about, a lot of appraisers shops did back when they had a substantial amount of trainees, when they were able to do that. And I'm not talking about the chop shots either. I'm talking about the ones that are out there, good quality appraisers, but that you knew and I knew back in the days, of course, before the crash. All right, let's talk about something else. All right, let's talk about forms. There's all this talk, there's all this communication out there with Fannie Mae and Freddie Mac about a new form coming out, a new form. Let's be quite frank about it. There's no new form. This is a software application. Am I right about that, or am I wrong? There's a software data service here.
FHFA has has 2 mandates out to the GSEs right now.
Okay.
One of them is an update to the Uniform Appraisal data set. Okay.
I'm with you.
And that they work on together. And that's where we're getting this idea of what kind of form changes are we going to have. Now remember, ultimately at the end of the day, it's the data points that need to be collected that they're most interested in, right?
That's right.
That's the fuel that runs CU, it's the fuel that runs LCA.
ACE, the flying ACE, is that LCA?
Well, that's LCA is Loan Collateral Advisor. It's kind of like CU for Freddie.
I got you. Okay. All right.
So it's that appraiser refined data, right?
So they want the data points to feed the machine.
So they're working together. By FHFA has said you guys have got to work together to expand the data set, refine the data set, look at what a new form, if you will look like.
Right.
Although it'll probably be more of a process than a form.
Right. Don't you think it's going to be more cloud-based?
Oh yeah, I would.
And data's coming at you, and you're going to look at it, and you're going to say, okay, as the data comes at me.
That's what I would hope. But
you're going to, because you made that analogy. You said as the data comes in, then you're going to steer it. That's your hope. I think that's going to be the case too. Why would Fannie or Freddie ever go with another quote-unquote new form that would be required?
The second part of the process has been mandated is the appraisal modernization.
Modernization. There's the word. There's the word.
Wait, but that is different than the data.
You have to tell me. Okay, tell me about modernization.
That one on the modernization side, that they do independently. So they're not to work together there.
So each one of these entities, the GSEs,
that's because they need their own market edge against each other.
So what is their definition of modernization? What do you think it is? Give me your opinion, because you're tech savvy.
Well, I think modernization not only involves the form, but processes around that, around how appraisal is done.
Okay.
So, for instance, the bifurcation idea, the idea of having someone else inspect and the appraiser remain at their desk to increase efficiency,
which has been around for a long time.
Has been, yeah.
But the application is different now. But go ahead.
But that would fall under modernization, not under data.
That would fall under modernization. Right. So the modernization is more the process, if you would, the process of how the appraisal is performed.
And I think they have a 3-year time period to do all this.
Right. But can I ask you a question? Can I ask you a stupid? Now let me ask you this question. What you're talking about when it comes to bifurcation, and we notice that, and we look at that as modernization. But you were doing that in 7. You were doing that in 6.
Sure, absolutely.
So the business model that you had in Cincinnati, Ohio in 2007.
Yeah, it was an alternative report.
It was an alternative report back then. We knew several people that did those type of reports for different types of scope of work. We've fully modernized. We've gone the full modernization route. I mean, how fast can it take to get an appraisal back? Are they looking at something? Are they looking at hours back versus a day, 2 days, 3 days? I mean, is this the whole concept of modernization?
Let's hope we keep appraisers involved, right?
Well, that's the whole thing. I know. That's true.
Because we had the property inspection waiver, which was interesting the way Fannie phrased that.
Yes, they did change it.
Last week.
Last week they changed it to appraisal waiver.
Right.
Okay,
now,
so that's what it is. Because it was misrepresenting what it was. Property inspection waiver. You put a PIW in front of a homeowner, they're going to think that you're waiving an inspection versus an appraiser.
Ultimately, I have first of all, let me go on record here.
Yeah.
Nobody has said anything to me. This is all Ernie Durbin.
You are highly connected.
You are a highly connected person. This is all Ernie Durbin's opinion.
Okay, go ahead.
But I think finally they realized the marketplace was accepting of no appraisal, so they called it what it was. Prior to that, it's kind of confusing, and now they're saying, I guess people are getting along with this. We'll just call it. Maybe it's a marketing ploy to call it appraisal.
And that's why there's Voice of Appraisal, and that's why there's Appraiser Fest and 100%, and the ASA is coming to Appraiser Fest this year to have the general public understand the importance of having the appraisal done.
Yeah,
it's very, very important. That's where the new paradigm, if you would, needs to go out to all of the people out there. And this is consumer advocacy too, Ernie, as well.
But I don't want to misrepresent myself either.
I understand what you're saying.
So here's what I'm saying.
Okay.
I was saying the name change. Maybe the reason why they're changing is because it's become more acceptable in the marketplace.
Yes.
Let me tell you that I firmly believe that there is a certain percentage of equity lending that can occur without an appraisal.
Equity lending But without an appraisal,
even origination.
But what's okay?
So I'm not against the property waiver or the appraisal waiver.
Okay, but here's my issue. Okay, now let's look at it.
I'm just saying it's a part of the.
It can be part of it, but here's the problem. The problem comes into play is when the PIW is issued on a sales transaction. On a sales transaction.
Yeah, I've heard your.
You've heard my argument, because the risk to the bank may be, minor, because the down payment may be substantial. All of these things, but at the same time, remember, the appraisal has not been done on that property, and because of that, when that property closes, guess what? Maybe that homeowner did not see a copy of that appraisal. They paid the amount that was that they were in the contract for, and then that property becomes a comparable.
Yeah.
And once it becomes a comparable, then it can have an effect on another transaction, and then the next transaction can become another comparable, and then it could get out of control.
I know your argument.
It's a good argument. It's an excellent argument, because we've seen them throughout the country where that one PIW sale, and not only that, the MLS is out there. Hold on one second. Now listen, it's my camera. No, I'm just kidding. I've seen PIWs where they're issued. They could become that sale, and even on the refinance situation, a homeowner will, guarantee on the lives of their grandchildren that their house is worth a certain amount of money because the house down the street just sold for that much money, and maybe a PIW was issued.
Right.
Your thoughts on that? That's my side of the argument. Give me your thoughts.
Well, my thoughts is that my tribe is appraisers, right? And I know that appraisers that do their job verify information. Right. They look at comparables. There may have even been an appraisal performed on a comparable, but they say, hey, that's outside the norm. That is not representative of the marketplace. I'm not going to use that comparable.
Oh, but that's Pollyanna. That's Pollyanna. No, go ahead.
I trust the appraiser's judgment. I guess unlike you, Phil, you think they have to self-verify.
You're going to get a telephone call from the homeowner, from the loan officer, from the real estate agent. They're going to say to you, you don't know what you're doing because you didn't take into consideration the comparable or the sale that took place right down the street. That's what's going to end up happening time and time again.
I told you my father brought me in this business.
Yes.
And one of the first things he told me is, son, if you can't stand the heat, you're not going to be able to stay in this kitchen. You are the only person that doesn't have a dog in this fight. And,
True.
And you've got to realize people are going to try to influence you all the time.
True.
But you have to stick to your guns. Hey, that room right behind us there, RAC, Relocation Appraisers and Consultants. Those people specialize in relocation appraisals, and guess what part of the assignment conditions are for us as a relocation appraiser is to consider comparables provided by the homeowner.
Yes, that's very true.
That's part of our job.
That's very true. For the anticipated sales price.
These guys all put their big boy pants on in here and skirts, and basically say, you know what? Sure, tell me what you want. About comparables that you think I ought to consider, and then I write in my report why I didn't use them.
Very true. But that's with anticipated sales price.
It is.
It's with ASP.
But I would argue that appraisers just need to stand up.
But I'm not arguing against that. I'm just saying that this is going to put increased liability on appraisers, because as we get into this market where we're starting to see more of a shortage of certain inventories of housing, then real estate agents will swear up and down on certain things if they don't get their way. They may report an appraiser to a state board. Now all of a sudden the appraiser's got to deal with that too. Look, it's not about the heat in the kitchen. It's about being aggressive and effective in reducing a lot of that heat on appraisers by processes that are being taken into consideration by the GSEs and FHFA. And that's a big problem for us. They need to understand this and realize that if they want to have valuation done by real estate appraisers, the appraisers cannot have a certain amount of liability on their shoulders, which they could cause by their own process, by their own policy, and that's my issue. Someone's got to stand up.
Fannie or Freddie could cause by issuing
by issuing a PIW, and that is a big problem. And even during go ahead.
You can call me Pollyanna, but I really trust that appraisers out there will vet information and not be influenced by
sometimes
that because we see cash deals in Cincinnati all the time. Hey, there's a lot of people coming in Cincinnati. We got some big industry in the relocation business.
That's right.
There.
Right. A lot of cash sales.
I remember a case where a guy, he came in from Long Island. And he was in a Cape, and this was like 15 years ago, Phil. He was in a little Cape Cod out there that, 1,080 square foot Cape Cod, you know,
sure.
with a 700 square foot floor plan, and
sure,
yeah, and he sold it for $410 out there, and of course $410 buys you a lot of.
That's cheddar. That's Cincinnati cheddar.
A lot of house in Cincinnati, right? Well, guess what? They wanted him to move back 8 months later, and so he calls me up and wants me to come out and do a pricing appraisal for him because he liked what I did for the first one.
Right.
So I go back out there and I said, well, hey, what's going on? He says, well, they want me to move back. He said, but I don't think I'm going to. But I tell you this story because you know,
well, you're talking about cash buyers.
We get a lot. We get those guys in Cincinnati a lot. Where they come from one of the coasts, and it's so affordable that they'll snap things right up. And I vet that stuff.
But I totally agree with you. But see, when it comes to cash buyers, that's and I totally agree. But that's a data set that we have because MLS and our MLS data systems have cash buyer on there. Mm-hmm. So I can go into a marketplace, create a data set, and find out if there's any indication between value differences or price differences between cash and conventional buyers. Right. But you're talking about a situation here where this is a financing buyer that now has the purchasing power of a cash buyer. Do you see the difference? Do you see how it can really change things around in the course of a very, very short period of time?
Now, I do realize that in the mortgage appraisal process, with the compression that appraisers experience in fees and things, that maybe verification doesn't go as deep as it does in the relocation space, right?
I agree with you. Right.
So, but you know, in a relocation space, when we're, you know, each one of those sales, we're calling the real estate agent and talking to them about it.
That's right.
So, you know, if you have a sale that's unusually high, I would encourage you to pick up the phone and talk.
I think most appraisers, when they see that type of situation, the due diligence gets even deeper and deeper and deeper. Right. The only issue is they've got lenders and they've got clients that are saying, but we need it back now, we need it back now, we need it back now. And I think the biggest thing, and you would agree with me on this, being a representative of an AMC, is that we need to work with clients and banks and say, look, turnaround time cannot be the number one issue. Quality has to be the number one issue.
Interagency guidelines state that explicitly.
But is it being followed?
I don't know.
There you go.
Just saying.
I know what you're saying.
I can point you right to the selection of appraisers in the interagency guidelines, which are the guidelines that were all the different agencies that regulate credit unions and banks and other thrifts and things like this. They're all regulated by some are by the Fed, some are by OCC. Right. They all come together to produce this document, and specifically it says in there that the appraiser should not be selected based on turn time or on
compensation. Yeah, exactly.
So now, you know,
use that power that you have, Ernie Durbin. Use that influence. Use all because you got a lot of money behind you. You know, you got. And when I say behind you, I mean the people that you hang out with have got a lot of money. Use that to maybe lobby some of the larger institutions to say, look, this is the best way, and this is the best path to go down to create a better, more compliant appraisal report.
I do appreciate that, and I do the best I can to lobby for appraisers. But there's a certain amount of momentum that's in the marketplace that I really. What I'm more concerned about is if we as appraisers do not modernize ourselves. Why do we have someone else modernize for us?
Okay, now, but you're going back to that word again. You're going back to that word. It's the same type of appraisal business you ran in 2007.
But if we don't adapt to the demands of the marketplace and the intended user,
okay, and I have to ask you this question then: what is the demand of the marketplace? Is the demand of the marketplace we need to have the appraisal back in this many days?
There's no question that that valuation appraisal is the long tent pole right now. I mean, everything else is really shortened electronically. And so, you know, we're the ones that are the speed bump.
Okay. I'm loving it. I'm loving it. No, you can be honest. I mean, that's terrific. So let me have you envision something. This is a very interesting interview. Let me have you envision this room. Okay, and we talked about this last night. It's a room where you have a bunch of valuation tech people in the middle of a cubicled room, and on the outside you have all of the quote-unquote appraisers, okay? So you have the inspector out in the field, the inspector does their job, the inspector then sends the information back to the quote-unquote value tech, who probably is not a licensed appraiser at that time. It's probably an evaluation of some sort, a salary position of something. That goes to the value tech. If it's homogeneous, if it's cookie cutter, if it's pretty much cut and dry, you have a confidence score come in on it too. Just like I did when I was a kid in college, okay? I was a credit analyst. I didn't have to have some state certification to be a credit analyst. You know, Federated Department Stores hired me, and that's what I did. So I think you'll have that situation, don't you agree, where you'll have those people in the middle that will be there to verify that value, derive that value, and if there's anything in an outlier that's unique, then it goes to that outer rim of real estate appraisers that are escalation, and I think it'll go in that direction. Is that the room that you see in the future? That's the room that I see as being pushed in the future. If there's a major crash or correction in the marketplace, I don't think they're going to have that room, but don't you agree that that could be a room? That could be the way that this world goes down. So you have the tri-merge takes place for a certain amount of money, and then boom, you've got your credit report back, and then for a certain amount of money, boom, you have a valuation indicator back too. You're ready to go on the loan. Don't you see that happening perhaps? That room?
Well, in a rosy scenario.
Yeah. Pretty doable though.
No, but when I say rosy, because part of what I see in the future as we continue to rely on data is more and more evaluations that are based on analytics. And less that are involving any type of evaluation analyst or an appraiser, right? So the stratification that I really see, the room, it's not really a room, it's a process in the future. I see 20 to 25% no appraisal.
25% no appraisal for risk assessment verification.
No, just for, let's talk about an origination.
For origination, 25%.
That's what I see. You know?
No appraisal.
No appraisal.
It's going to screw up the data service. The data set will be messed up. Because
I was going to try to
go ahead. I'm sorry. Go ahead.
It is hard to get a word in edgewise with you. I'll tell you what, man. So and then
you're doing good.
And then about 35 to 40% of these bifurcated products.
Okay.
And then another 35 to 40% full appraisal.
Full on-site.
Now, you know, those could go to 30% no appraisal and 40 to 45% with an appraiser remain at their desk, and then 20% full appraisal. I mean, that's the way it could go.
Right.
But I think that we're going to see that kind of stratification. The efficiency way that you were it was remarkable when you were talking about that. We actually used to do business that way at Durbin. Every one of our licensed and certified appraisers had a para appraiser with them, right?
Yeah.
So they
and a lot of people still to this day have a shop like
absolutely.
that.
Right. And so that's not a far stretch.
But that's a normal training shop.
But under that scenario, my signature was at the bottom, or Chris Hughes or any of the other appraisers that worked for me down through the, Bill Walton Ball, their signature was at the bottom because they were taking ultimate responsibility. It sounds like the room that you're talking about is where appraisers don't necessarily take responsibility for every assignment.
Well, no, because they're done on an evaluation scenario by a non-licensed person, and I think that could be the case.
I got a real problem with evaluation, the term, because I think appraisers can.
Appraisal Institute loves it. Well, they love that term. But go ahead. I'm just go ahead.
Well, I'm an SRA-AIRS. That's my tribe too. So, dude, the only place
I didn't say it was going to be softballs, baby. I'm not throwing softballs at you.
The only place that we can find consensus is Cincinnati. But,
all right. Okay.
No. Now listen.
Evaluations.
I would say I do think the Institute may be a little off base there, trying to say let's allow evaluations for appraisers because you can do them now. USPAP allows you to do that. It's not that
But
tough.
you still have the standard 2 reporting situation. That could change very soon. You never know. But at the same time, and I'm not going to bring up fees again, but the cost of evaluations are a certain thing, cost of appraisals are something else. When you open up that avenue to have more and more people do your job, especially on the commercial side, then you're going to start to see your compensation go down.
I guess the point I'm making is if people want I'm talking residential.
Residential side. Okay.
So let's just talk residential at this point.
Okay.
If people want evaluations now, the reason why they want it is because they think they're less expensive and they can occur quicker. Right.
Right.
All right. I'm telling you, the MVP product we produce through Clarosity.
Yes.
It's as inexpensive and is produced in as quick a manner as an evaluation.
So we have this after party that's going on in San Antonio, Texas.
Yeah.
And some AMCs have sponsored it.
Oh, excellent.
Yeah.
You might as well make some money. Might as well have some drinks.
Would Clarosity be interested in sponsoring something like that? Very cheap. Very cheap. You'd like it too. You'd like it. You know?
That's a Shane Copeland question.
That's a Shane Copeland question. We'll ask him that soon enough. Right. The one thing I will say is when it comes to that room that I was talking about, in that room, there's a lot of people out there that have inside a valuation job. What I'm interested in is promoting an appraisal profession.
Yes.
And there's a big difference there, Ernie. You've got to admit that there's a big difference. When I sat as a credit analyst back when I was 22 years old, that was a job. That wasn't my profession. We still need to have professionalism in the industry.
And there's a reason why the the securitization folks and the servicing folks are adopting these bifurcated products over BPOs. They know that BPOs are an inferior product to an appraisal. The problem is, hey, let's look at post 2007 when we had that total glut. There's no way the amount of appraisers could have handled the valuations that were occurring.
I agree with you on that.
So they went to BPOs, and they realized that the rating agencies, Moody's, I've been in Moody's offices, been in Fitch's offices, Standard & Poor's. That's part of my job is to go see them and explain our product. And they prefer appraisal over BPO. Everybody does. The question is, when you're valuing a property 3 or 4 times in the course of a 5-month disposition of that asset, and you have to have it done quickly, and when they're trading portfolios,
I'm not disagreeing with you. No, keep on going.
When they're trading portfolios, sometimes one buyer is selling a group of 10,000 loans to another.
Right.
And they offer to them based on their own valuations. That person, that buying entity, might only have 5 business days to get their bid back.
Correct. Yeah.
So you got to value, a lot of properties in 5 business days.
Right.
So in that case, there's not enough appraisers. But what I'm saying is, appraisers, there's an appreciation for appraisal above and beyond BPO.
Okay.
And I think that there's a place for appraisers to pick up a lot of that business. We just have to think about a different scope of work.
Well, I agree with you on that. And I have one other question, because you keep bringing up all these points, and I have all these questions to go with.
Go.
Let's talk about Moody's. Let's talk about the bond rating agencies. They took a lot of hit in 2007 and 2008 because they didn't rate the structured investment vehicles correctly, correct? What is their opinion on the PIW process and the appraisal waiver process? They're buying the paper. They're securitizing it. It's being secured by some of these.
Of course, I can't speak for them, but I can tell you that based on a report that came out of Moody's, a recent report regarding alternative appraisals versus full form appraisals.
Okay. All right. Okay.
Where they were criticizing the alternative space, and now, by the way, nobody reads that report except for geeks like me.
All right.
The alternatives that they were talking about, by and large, were BPOs.
So they're not the bifurcated.
That's part of it.
Part of it.
That's part of it.
Okay.
But their biggest concern was BPOs.
Okay.
Now, which by the way, our company does BPOs.
Oh,
we do BPOs. So I'm not, I just.
You're doing good, Ernie. Keep it going.
Just want to be honest. I don't want somebody out there, well, he's bad-mouthing BPOs, but they do BPOs. Hey.
No, it's open transparency here.
We actually have a slogan for our BPO merge product, which is a 3-opinion BPO that then takes the data and calculates a 4th opinion.
Wait a second, 3-opinion BPO, and the product's name is the dartboard.
The BPO merge now. Hang on. Actually, it tested very well against appraisal. But I will tell you that in the slogan in the beginning, when our company was rolling out in 2012, our slogan was BPOs suck. Okay. Ours suck less. You know, I mean, that's all. That's what it boils down.
That's good marketing, Ernie.
Yeah, well, it's honest marketing.
It's
anyway,
honest.
So,
yeah. Well, anyways.
So anyway, but I mean, BPOs have a place in the marketplace, in the portfolio, and the
but I think
space.
I'm going to be honest with you.
But I think appraisers can get in that space.
Yeah, I think that with the lawsuit like Tyndall versus Murphy out of California, where the decision was made that there was the appraiser had no duty to the individuals that were buying the house, making the decision to buy the house. I think there's a really good opportunity here to have the appraiser model, the modernization, the modern appraisal model. And I'm not talking about something that has to do with compliance. I'm talking about business. I'm talking about where our business is going to go, can be with the home inspector model. The home inspector model is perfect because what you're looking at now is basically saying, look, when you buy a house, the appraisal that's being done for the bank or the lending institution, number one, may be bifurcated, number two, may be traditional, or number three, that guy or that lady has no duty to you as the buyer, period. So it doesn't matter what it is, they have no duty to you. It's going to be in your best interest to have the appraisal done at the time of the purchase. And that's a very difficult argument to make right now because there are the situation where you have multiple offers, you have certain marketplaces where people are just diving in. I think a lot of that, of course, has to do with the fact that when a property becomes active, it's sent through thousands of people on their phones and Zillow and all those people, right? Yeah. They get it and they send it out, and now all of a sudden you're taking days on market from 30 down to 30 minutes because everybody's got it. Everybody's got the information. But that being said, still, I think it's very important that you have to have that appraisal done. I can't just send that message out there. That message has got to come from the American Society of Appraisers, the AGA, the AI, which is backing up evaluations and is not going in that direction. This is a good marketing strategy for real estate appraisers into the future, and I see it being very advantageous.
Yeah, I think to say AI is not backing up
I'll retract in a little bit.
Right.
But go ahead.
I was gonna say,
but here's the thing.
They're just trying to keep appraisers involved in the process if the process is headed to evaluations.
But they can steer that off by correctly going out there and representing appraisers in a different light. Mm-hmm. See, it's all about marketing. It's all about you have a situation here where it's consumer advocacy even above public trust.
Listen.
It's consumer advocacy over public trust. The consumer must understand what the market value of that home is. And they would like to have, a lot of them like to have me show up or you show up to the house, go through a complete analysis like you do on your personal appraisals, like I do on mine, and show them the marketplace. Remember, this is your client. Discuss whatever you want. This is your client. This is the intended user. It's carte blanche for you to say whatever you need to say to them. Yeah. That is so valuable. That is so important. And that is the new product. That's the product of the 21st century that appraisers can look at. If they like doing things in quote unquote the traditional manner, that's a great way to go down. Have you ever seen?
And look, not everybody's going to select that, but if 10% of the market did, there'd be a lot of business.
There'd be a lot of business, and you can take that message to the National Association of Realtors on November 1st, 2nd, and 3rd. That's the same time as Appraiser Fest is, and you send one of your guys down to Appraiser Fest, and we can send that message up to the American or the NRA, and maybe they would understand that. And maybe they would say, "Look, this is important."
NAR, not NRA.
In the NRA, in the NAR, not to confuse those two together.
Right,
Thank you, Ernie. I appreciate that.
Yeah.
You got me out of trouble on that one, that's for sure. But no, I really appreciate the conversation. You know, and I think we've cut through a lot of stuff here. You know, I mean, the bottom line is that there are going to be products out there that banks are going to want to have that are bifurcated, and I understand that. And you can't do portfolio acquisition or pre-foreclosure drive-bys and have 7 or 10 or 15 of them done within a 3-week period and have that be, you know, profitable to the bank. They can't afford that money. But at the same time, there has to be this advocacy towards a profession that still has a substantial amount of value to the consumer more than anything else. And what we're going to try to do through Voice of Appraisal and through Appraiser Fest in 2019 is a national marketing strategy to get out the word to the National Association of Realtors, to get out there to consumers and to consumer advocacy groups that look, just like, how many times have you ever seen a sales contract where they waive the property inspection, where they waive the home inspection? I see very few and far between. Mm-hmm. The realtors push it. They say, look, we don't want that.
You know, we just sold our house, and I probably would have required it if they didn't.
Exactly right, because you want to make sure everything's covered. You know, you filled out your property disclosure part of the contract, but you want to make sure that you're okay. But the same thing holds true with the consumer and the realtor that has a fiduciary agreement to that consumer, and I think the appraisal should be done. It's a great way to do business in the future. It's a great way to market yourself, and I think that's what we're missing first and foremost, all right? Ernie, my fellow Cincinnati friend, thank you very much for coming on the show with me. I really appreciate it, and he's a good guy, guys. He's a good guy. I give him a little bit of horns. I give him a hard time. I give him a hard time, but you set me up so well with the sausage line. You set me up so well with it. I had to run with it. That's radio in Cincinnati.
Well, I mean, you can tell from my size, I do like sausage.
Folks, you hang in there. We'll be right back. You're listening to more with Bill Crawford on Voice of Appraisal.